Does Index Universal Life work for big settlements? Can I put it all in at once? What are the tax implications? What does this look like compared to other vehicles? Let's get into all of that right now. The very first question that most people are concerned about in terms of settlements is, can I just put the money in one swoop? With IUL, many people do know because of the TAMR law, Technical and Miscellaneous Revenue Act of 1988, you can't fund a policy just in 1 year like that. Usually it's going to be spread out over around 5 years. Now, many insurance companies have what's called a premium deposit account. Now, they function differently company to company, but a lot of the times we're just going to use a $10 million settlement in this example. What'll happen is, even though they're going to have to spread that out over 5 years, well, they still want that $10 million to be growing before it goes into the policy. So maybe they'll say, hey, you can give us the full $10 million. We'll fund the policy over 5 years, and we'll make sure that you don't create a modified endowment contract. It's not considered an investment. It's not going to be taxed once it's in the policy. But while we wait to do that, we're not just going to hold your money and give you nothing. We'll put it in this premium deposit account, and we'll say we'll guarantee you a 4 or 5% rate. Some of the companies that I use will even go up to 5.25%. So they'll say, we're going to guarantee you get 5.25% on this money. Of course, since that's in a premium deposit account, kind of like a high yield savings, that's going to be taxed. But just the gains are taxed on that. The gains are taxed, you pay taxes on those, they put it into your policy, and it does work similarly to if you had put it in one swoop, because the insurance company is just doing it for you. You give it to them, they'll take care of the rest. Again, the gains on the premium deposit account would be taxed. Of course, when the money goes into the IUL, you'd be accessing through tax-free policy loans that you don't have to pay back, and those are tax-free. We're going to take a look here at an example of a 50-year-old who ran into a $10 million settlement, or at least they had $10 million that they wanted to put into an IUL after the settlement. So let's say maybe it was 20 or 30, they spent some money doing some other things, and they had $10 million left. This is what I want to put towards an Index Universal Life. How would this look? So that's exactly what we're going to illustrate. 10 million starting at age 50. So after year one, it's going to show age 51 in the starting year, even though they started at age 50. And then we're not going to show any loans. All we're going to show is just if you put it in, it was in a premium deposit account and you let it grow. What would it look like? And then you can kind of deduce from there. If I were to take loans at this point, here's how much money I would have to do that. All right, so you can see on my screen here, I have my sum of balances over here equaling 10 million, and I gave this premium deposit account just 5% growth. I put the age as 51, that's the starting year. We're actually at age 50 when we do it. Put the life expectancy to age 100, that shouldn't matter. And then I put the taxable income at 300,000, including a 6% state tax, married filing joint. That would affect what your taxes would be on the 5% premium deposit account. Of course, you would change this for yourself, but just for this example, that's what we're going with. And then we are going to assume a rate of return of 7.2% just for the rule of 72 for simplicity. So we click build bucket. We are going to scroll down and we can see it automatically adjusts the premium to what it needs to be put in. So we're getting in it as fast as we can, but you notice right away, this is putting in a whole lot more than 10 million. That's because it was in that account growing while it was being waited to put in. In this case, actually 626,000 more than if you had just put in the 10 million with the premium deposit account. And after the taxes we paid, they were able to get in the 10.6. And that is the sum of these 5 numbers right here. So you're a little above break even here in year 5, and then you can kind of continue to go down. If we just say 10 more years, in this case with 7.2, it's doubling about every 10 years. So we go to year 15, then we go to year 25, and it's just going to continue to grow. So if you were someone who ran into this money and this was money you didn't want to touch, or you just wanted to leave there and kind of look at it later to pull out for a big business venture or something like that, you would have access to this surrender value. So as you continue to come down throughout the years, if it wasn't until age 75 that you wanted to touch it, assuming the 7.2, this is just a hypothetical, again, just for illustration purposes, 42.9 million you have there access to just via the loan balance. Now, if it was much earlier, say you wanted to start taking income in year 6, you could do that as well. And if at any point you died, you have this tax-free death benefit that would transfer to your heirs. If you're curious kind of how the internal rate of return works on this, I do have another video on calculating internal rate of return. I recommend that. I'll link it in the description. But that's very important, especially with these large sums, because what happens is a lot of people will compare a chart like this to, say, a mutual fund and say, oh, well, this is gaining 11% a year, which isn't a number I would necessarily rely on first off, because that's not the compound annual growth rate, that's just the average. But what they don't take into account is not only management fees if you do have a financial advisor, but the taxes. If they have $10 million, you can expect they'll be in the 37% tax bracket, for example. Well, 37% of that might get taken right off the top. So when you are comparing vehicles, make sure to consider the tax implications. In this case, we wouldn't have any because we'd be accessing through tax-free loans. Of course, we would have the taxes on just the premium deposit account, which would be a small amount. Once the policy is funded, we would be taking policy loans that we don't have to pay back. When we die, all that happens is the death benefit just subtracts our loan balance and the additional gets passed to our heirs, tax-free. Why? Because it is insurance. That is a simple explanation of IUL for settlements. I think they're a great option, especially with the tax-free access and benefits. A lot of people getting settlements are going to push themselves up into such a high tax bracket forever that this could make sense to try and get into a tax-free account. And if you have this much money, if you're planning on using it to start a business or something, you can access it and still have it be working for you while you are doing that. So just my 2 cents. A lot of people, for example, would maybe recommend some real estate. What's nice is that this can actually complement real estate. You can have money in here, you can borrow from it, buy real estate, you can use this to liquidate your real estate. So you still have your real estate properties that are appreciating in value, but if you are someone who's going to be active in your real estate properties and you do want to use leverage to your advantage, we also want to make sure that that leverage has liquidity. I'll make some more videos on that in the future going into greater detail, but if you did find this helpful, I do ask that you subscribe. This is what this channel is based around, is going into the nuances of indexed universal life. I don't think it's the only thing that you should use for your retirement or for settlements. That's just where my specialty is, and I typically defer to others for the rest of the portfolio. But again, if you found this useful, be sure to subscribe, and I will see you in future videos. Bye-bye.